today we're going to try and accomplish two things. I was inspired to name this talk because of a book written in 1997. Anybody know the name of the book? Poe Bronson, and the book was called The First Million is Always the Hardest. I think if he wrote it today, he would write The First Billion is Always the Hardest, because a million has become somewhat of chump change. But the idea was a fiction set in Silicon Valley about a founder who is trying to make it, and the political things and the fundraising things and all of the obstacles that occur. So getting to the first million will be part one. How do you get there? Keeping that million and spending it wisely is part two. And so with that, I'm going to introduce our panelists because collectively, they have a lot of experience in both raising and allotting money wisely. And so I'm going to start right next to me with Leesa, and she'll tell you a little bit about herself for a few moments. Leesa?
Hi, I'm Leesa Eichberger. I work as a chief marketing officer right now in a fractional capacity. But I have been Chief Marketing Officer of RingCentral, the software company. I ran marketing for Farmers Insurance. Prior to that, I was the Chief Marketing Officer of Jenny Craig. And now, like I said, I'm focused on being a fractional CMO. I'm working mostly with brands in transition and brands that really are trying to change how they're running their businesses. From an investing perspective, what I kind of bring to the party here is I'm an angel investor, and I'm working with a couple of small organizations that really look to raise money as angels, but we work together when we do due diligence so we can really get the best thinking of kind of a hive mind of how to invest. And then I'm also an LP with Halogen Ventures, run by Jesse Draper. And in addition to that, I'm on the board of advisors for Hypatia Capital, which is an EFT that runs WCEO. Our focus there is to invest in publicly traded US companies that are run by female CEOs. So that's my background, and I'll hand it to...
No, that's great. So keep in mind, think fractional, because it's somewhat newer and really an important tool in your tool guide. Larry.
Hi, this is Larry from Amino Capital. I'm the founder and the managing partner. We have been around for 13 years. We invest almost 400 companies. 20 of them have become a unicorn. I'm glad to know that some of you are the users of V. We wrote the first check for V. Also, fortunately, I was one of the angel investors of Zoom, which you all know. So we like to work with people. We like to identify the people who are work hard, tenacious, resilient, and fortunately, I was on the Midas list 3 years in a row. That's like whatever you touch become gold, which is something my wife never feel that way, even right now. So, but never mind. But that's me, Larry from Amino Capital.
Right. And Amino Capital is in Palo Alto.
Palo Alto, California.
And very funny, the translation translated it as tomb, but it's Zoom, correct?
Yeah, Zoom.
Right. It's a very funny translation. All right, Barry, take it.
Hi. Can you hear me all? Hear me? Okay, great. Barry O'Neill. I work out of Tokyo with a small investment and investment advisory group there called Value Create Ventures. How I ended up in Tokyo was Value Create was actually an investor in my previous startup. I have founded 3 startups. I founded one in 1997, which was one of the OG .coms, and also imploded in the OG .com implosion. And that was in the consumer media space, online media. I then did a consumer games company with a couple of co-founders, one of whom's in the audience here today, from 2002 until 2006. And then I was a founding CEO of StoryToys, which was a consumer ed tech company, which I exited in 2020, and Value Create was an investor in that, along with Emerson Collective and a number of other high-profile investors. So it was a very good exit for me. So I moved to Japan to actually, my second company had quite a strong relationship with Japan, and I'd always wanted to live there. So it was kind of my dream job to go out and start working as an investor global investor from Japan. I'm also quite heavily involved in Techstars, the acceleration program. So I'm the entrepreneur in residence at Techstars Tokyo. So kind of being on both sides of the table, being in the startup space, have to raise money 3 times, failed once. It's a very difficult process for me at the time. And now I'm lucky enough to be on the investor side. So hopefully I can help answer some questions from the audience.
And representing a company that has actually raised their funds, Lockie?
Yes, I'm Lockie Andrews, and like the panelists, I actually have held multiple roles. So I started my career after business school at a startup, so the dot-com era, and actually raised over $100 million for that startup. It was ultimately sold to Right Start. It was a consumer brand. And then decided to go actually to work for venture capitalists and private equity firms because I really loved helping to scale companies. You may have heard of Untuck It, the shirt company. I see some nods. I like that. So when I started working with Untuck It, they had just taken on investment from Kleiner Perkins, and we tripled the size of the business. So I really like to get involved with companies that are high growth, great opportunity, huge TAM, and my specific expertise is in helping those companies grow from a marketing perspective and particularly in understanding digital marketing. And so from there, I started my own consulting practice, and in working as a fractional at times with the actual owners of the companies, opportunity presented itself for Rich Hair Care for me to purchase the company and their America's rights and to raise money to start to position it as a direct-to-consumer brand in America, overseas, and it was over a $200 million business, but overseas it was through distributors. It definitely was not a direct-to-consumer brand, and so we have raised money here in the US through private sources, mostly family money from family offices, but it's been an exciting journey and I look forward to sharing more details.
Okay, and now in the never-ending surprises, I'm going to introduce your real moderator, not me, Dov Moran.
Hello, everybody. You know, Israelis are always late. So we have our own time. I talk about myself?
Yeah, we just finished the introduction.
Okay, so excellent. So I'm Dov Moran. I'm known as I'm coming from Israel. So it's 15 and a half hours flight. So I'm allowed to be late. I'm known as the inventor of the USB flash drive, USB stick. So actually, each one of you, I believe, was using it, except if you are younger than 20 years old. Established M system that was sold to SanDisk for $1.6 billion. Established Modu, which failed. Was chairman of Tower Semiconductor, a fab in Tel Aviv. Took it from bankruptcy to valuation, which is over $10 billion. Last year, I'm running a fund. It's Growth Ventures. We are a dev VC fund in Israel for deep tech. And does anybody know what is deep tech? Raise your hand. Okay, not enough. Deep tech, semiconductors, cloud infrastructure, core AI, materials, space, quantum, all the stuff that VCs are hating. Agree? Kleiner Perkins. And I'm here, very happy to talk to you about entrepreneurship and growing companies.
I didn't hear a question.
I'm supposed to run the questions?
Yeah.
That's great. Guys, I didn't know that I'm the moderator, but I am happy to be. Now I can control what you are saying, when you are saying. I'll begin with you. The question is how to make the first $1 million. Let's begin with a smaller question, like how to get to $100,000.
Well, there are many ways to do that. And I think from a success model, it's really important to choose your initial customer or client base, recognizing that they will be very important for your story in the future. And so picking those customers, clients, that space has to be strategic. But one of the biggest failures, and I didn't mention, I'm also an angel investor with Harvard Business School Alumni Angels. We see 12 companies every single month. And so having done it over 10 years, we've built a bit of a pattern recognition. And one of the biggest problems that startups have in that first $100,000 is they're so desperate to take the first check that many times those customers really should not have been customers. And when it doesn't go well, because it really isn't in the center zone, right? It's not straight down the narrow path for where that company needs to be, they end up panicking, right? And feeling like, oh, wow, I've completely left the zone that I was supposed to be playing in, but I need to appease these customers because investors will be looking at that performance. So I would say be very safe, right? You've put your time, your energy, your money, your reputation on the line. So make sure you take your time with those customers, interview them, right? To make sure they understand where you are, to hopefully push you through all the difficulties that you'll have in that first 100,000, and that they won't abandon you as well as you're going through the process. Because the worst thing is if your particular product is working, but your customers, because you've chosen poorly, are not the best customers.
That's a great answer, but before getting there, there's something which comes prior to that, which is very important. The first thing, in order to get to $100,000, is to establish a company. How do you establish a company?
Can you repeat the question?
How do you establish a company?
How do you establish a company?
Yeah.
Well, if you don't know how to do that, then you probably shouldn't be in the audience, frankly. It really depends on the jurisdiction that you're in, but the easiest way is probably establish a company via Stripe. And establish, there's a number of online services that you can use. I think from an investor perspective, if I'm looking at a founder that's coming to us, and I'm going to revert to the $100,000 question. The thing we will always look for, and this is related to establishing a company as well, is not do you have product market fit, but because a lot of times companies are talking to us before they have any customers, but is there founder market fit? Is this the right person? Is this person the right person to actually start a company and bear with the process of building a company? And do they actually understand the challenge that they're taking on, or is that aspirational? So we write very, very early stage checks. We'll back, pre-company founders in some cases. And that key thing is really founder market fit versus that's the first thing that I'm going to be assessing anybody that's coming in to pitch me is, are you the right person to tackle this problem?
If I can pile on to that just a little bit and what Lockie said, I think another thing that's really important when you're pitching is to understand who you're pitching to. Understand who your target audience from an investor perspective is. What matters to the investor? As I mentioned, I'm involved in an angel group, and we evaluate companies as a group, but then invest individually. I'm a marketer. You need to talk to me about marketing and what you're going to be spending my money on. Is it marketing? Is it product development? Like what are the things that matter to me? What are the things that matter to other investors? And I think a lot of times people get excited about their product and what they think is important, but don't take into account who the investors are and what's going to matter to them. And you're asking me for my hard-earned cash. How are you going to spend it, and what are you going to spend it on, and how does that relate to me? And I think that's an important other thing to consider in early startup stages.
I'll get to you, but I'll make a twist to the question, okay? Anyway, that's one of the differences between Americans, and you are all Americans, and Israelis. Because you talk about technology, you talk about pitch. In Israel, we talk first of all about people. To establish a company, the first thing I believe you have to do is find your partners. No partners, no company, no $100,000, not $1 million, not $1 billion. How would you find a partner? And how do you really make a company to begin working, raising money, all the rest?
So when you start a company, the number one is who? Who is going to be your partner? How can you get it? Number one, when you start a company, you always choose a timing. The conventional wisdom says the best time to buy a house in US is what? 7 years ago. The best time, you look at today, the best time to start a company, I mean conventional, is 5 years ago. That's a conventional. Common sense only leads to common result. Only extraordinary action can get the extraordinary amount of money. So the best time to start company is always today. You remember, next year you come here, you think, I should have started a company last year. So the best time to start a company is exactly today. If you are dreaming, that's too late today. You go home, start it. Why? There's no better way to find a founder by doing something together with them. When you work with a person, you figure out, is that person has integrity? Is that person can deliver what he or she said? There's no better way to find a partner by working with them. It doesn't mean your best friend, even your spouse, they may not be your best partners. Mostly not. The best way to get divorced is to start a company with your wife or your husband.
No way.
The best way to get rid of your good friend is start a company with them. Try it. So the best way to do it today. Find a partner, work on it. Then back to the question, who? Who? Number one is find something that can complementary to you. Don't find somebody exactly like you. You find somebody, if you're Asian, try to find somebody like a white or black. Don't try to find my classmate because we have the exactly same skill set, exactly same social resources. I want to find somebody who can go to somewhere, feels like a founders, a CEOs, right? You have to find someone who are very different to you. So that's why when 3 people come to my office, if none of them speak with accent, the chances of success is very low. Because a team with immigrants has much higher chance to be successful. Probably you know we have the least friendly president of the United States, Donald Trump. But you know why? But he's quite okay. He can become a president. You know why? Look at his team. His wife is an immigrant. Look at the vice president. He's pretty conservative, right? He doesn't like immigrants as much as we would like him to. Look at his wife.
Which one? Number 1, 2,
Second generation of
2, 1, 3, 4.
second generations of immigrants. Find somebody who are different than you. If you're white, try to find somebody like me. If you're black, try to find somebody like me. Or either way, you can. Or if you're a man, find somebody that's like not like a woman. Find a woman.
So
Can
I offer a
That's the other panel. The other panel talks about family life. It's wrong
I offer a
panel.
contrarian view on that. Just find somebody that's smarter than you. Because if you continue to work with people that are smarter than you, you will always be learning. And I actually started a company with somebody who I'd known since I was 14. I didn't know him that well, but I'd known him since I was 14, and he was way smarter than me. And then I took on somebody else who was also much smarter than me as the third co-founder. And that was great, and we're all still friends, after that. But I agree, absolutely, find somebody that's different. But the one thing that I will also say about a CEO, and this is unfortunately not something that I phrased myself, it was Fred in Union Square Ventures. A CEO has 3 things to do. The first thing is make sure there's money in the bank. Right? The second thing is hire good people, your ability to hire good people. And the third thing is the ability to be able to communicate the strategy and the message of the company to different stakeholders. If you can't do those 3 things, you should not be the CEO of a company. You can do other things as well, but that's the key thing. The ability to find and hire good people is really, really important.
Yeah, there's,
Let me jump a step forward, okay, and then we'll get back to you. So we do have a company. We have the right people. We have the idea. It's important to have an idea. Now there are 2 approaches within VCs. One, go without a presentation. Just talk with the VC, and that's fine. You have amazing idea. You have the team. You have the potential. And the other concept is, that's my concept. Don't come to me without a detailed presentation, and I really want to know everything, despite the fact that I know that probably all of it is totally wrong. What's your approach?
Yes, we've been in all of those pitches. So as I said, as an angel sitting on the other side of the table, it's terrible when I know more about their business than they do. So making sure you really understand your market, your space, your opportunity, so that if I, for whatever reasons, don't believe that this is truly as big a TAM as you're saying it is, your passion, your wisdom, your knowledge, because you've lived this space, you've proven it out through surveys or whatever the mechanism that you can prove, especially if it's something new, is extremely important before you have the meeting. Don't go into the meeting talking about what could be. You should be talking about what is and bringing as much proof as possible before you get in front of those investors, which is why especially if you're under $1 million, and it depends, if you're in tech and if you're particularly in a SaaS model, you should be talking to VCs. But for the majority of the universe, you should not be in front of a venture capitalist if you have $1 million or less. So part of this panel, we're talking in very broad terms. So really back to Lisa's point, know your business, but also know who you're sitting in front of. If you're $1 million and they're looking for $3 million in revenue, you should never start that conversation. You should say, I'm introducing myself now for when I'm at 3 million, but I appreciate when people have done their homework before they come in, and that's exactly how I approach my investor meetings.
Perfect. Go ahead.
I don't have too much to add to that. That's a great point. The thing I wanted to pile on a little bit on Barry's earlier point, just on who your partners should be. I got some really good advice at one point from one of the actual founders of Lululemon way back. And one of the things he said to me is, when you're in school, you're learning everything and you're trying to be good at everything and you want to get straight A's in all the subjects. As you advance in your career and advance in life, you have to come to recognize there are things you're really, really good at and that are your superpowers, and there's things you suck at. Don't try and be good at the things you suck at. Find people to do those things with you. So your partners need to complement you. I love what you said, Larry, about diversity in your partnerships. I think that's equally important, and especially when 2% of venture funds are going to women. We need more diversity in our investing. We need more diversity in how we're bringing parties together. So just kind of piling on, that was one of the things I think was some of the best advice I think I've gotten in my career, and I don't think that's just from an investing or a partner perspective. It's from a life perspective. Find a partner who complements you, that doesn't mirror you.
Yep. Okay, let's assume that we have a company, and now the question, the purpose of this discussion is, how do you get to the first $1 million? By the way, they didn't say, is it a $1 million revenues, profit, personal money that you got out of the business? But it's free for us. Let's assume that we got the first money and we are moving forward. How do we grow a company?
Yeah, so I think we got a lot of concern or question or whatever. With this AI, it's so difficult to start a company, right? Because whatever you do, the next large language model will override you because they just do it. So number one is, don't start with the obvious good ideas. The obvious good idea is not a good idea for startups. It might be a good idea for a large company, but not for you. We remember 3 words. Right nowadays, you go to start a company, go what? Go narrow, go deep, go with the flow. You know why? Because when you go narrow, you find a very niche market. You go in, get your market, get your revenue started, then you follow the flow, follow the customer's workflow to become a platform. Once you become a platform, you basically collecting money easily, right? So go narrow, go flow, go narrow, go deep, go with the flow. Don't go with the obvious good idea. That's a terrible idea if you do that. Don't do that. Give you an example. Always start something, feels like a very small idea. Very small. Nobody else want to do it. Like some of you here are the customers of a V, right? You know what? They started with the Chinese community. Do you know how many Chinese in America? 5 million. They do it with the Chinese community. Very small, not obvious good idea, very small market. Now they are $4 billion valuation. Do you know why? Because they start from the Chinese, then go to Japanese, Korean American, Filipino American, Mexico American. This is a country of immigrants. Now they are $4 billion valuation company. So go narrow. Do something small. Serve the underserved community. Help those people that large company don't want to help. Always help the people who really need help. It's really easy. Frankly speaking, that's not political correct. It's more easy. It's a lot easier to make money out of poor people than those rich people. Because those rich people, you want to get the money out of them, it's difficult. That's why they are rich. Right? Work, help the poor people. They are easy to pay. Rich people, no. Don't think about them. You have to work with Eichberger, that kind of people, you know? So work with poor people. Work with the people who need your help.
Let me try to sharpen the question a little bit for you. There are entrepreneurs that will tell you, I don't want money from VCs. I want to get the first money, first $1 million, first whatever money, from angels. What's your opinion about that?
So we would position ourselves as an angel fund in many respects. And we would get quite heavily involved, although we will never charge a company. We will get quite heavily involved in helping a startup develop their strategy so that they can be better prepared for raising money from institutional VCs then. Why I say we are angels, I mean, our check sizes are run anything from like $10,000 to $250,000. We're spending our own money. We're not an institutional fund. So we try to align ourselves on the founder side. So we will help a company that we invest in, help them try to get to their first million. Help them try to get to their first million in both revenue and also help them try to get to their first million in investment, should that be required. I want to go back to another point that you mentioned, though. AI has sucked, some people say 65%, some people say more than 80% of venture capital out of the market at the moment. And a lot of that money is unfortunately lost dollars, right? Well, is wasted because, well, if you take the true doomist viewpoint as I do, there can be only one. When we head to AGI, there's really going to be one winner in the AI space. So we specifically are not investing in AI. We will invest in proprietary data sets. If you have a proprietary data set that you're exploiting, that's very, very interesting because you can get to $1 million on that and it's not something you can replicate. But also to give you another example, the last check that we wrote was in the arts and crafts space, but it was a venture backable company in the arts and crafts space. So, all we're hearing at the moment is AI this. It's like Uber for X years ago when in the VC community. We're getting really, really AI fatigued because you just will not be able to compete with the large AI companies if that's what you're looking at in the long term. So, as you say, go deep, find your niche, and often that niche is in proprietary data from my perspective.
Talk about AI because, hey guys, we cannot go through any discussion in this conference without talking about AI. But back to the question, VC or angel? What do you think?
Yeah, definitely angel, especially if you are not a former serial entrepreneur. If this is your first time in a space, I think exactly as Barry said, you need to really understand your market. There's a lot that you will not know, and your angel investors will be more patient than venture capitalists who have a fund, who have specific returns that they're looking for. So for me, the angel route is more of an opportunity for an entrepreneur to grow, and we'll grow together. Many of the angels that I've spoken to and those who I've taken money from, they want to get involved. They have an expertise or some passion about my business, and I have them on my advisory board. That, to me, is the best opportunity that you have. Yes, VCs will take a board seat, but it's very different when you're at that nascent stage. And then ultimately, where you started may not be ultimately where you end up. You need to have an investor base that understands that and is willing to grow with you, that you said you were going to do X the first day I gave you this check, but as you got in, you realized that the opportunity, and especially if you started small, may not be where you initially took that first check. It may be because you landed and expanded and realized that it was some other opportunity within a space that you were easily able to go after. Then you have to change your whole strategy. It's much easier to do that with angel investors than with venture capitalists who, if you are not in their charter, by definition, they're looking for a way to offload that investment. So if you are a first-time founder or an early founder, I definitely would advise you to take the more patient, safer route to growth, and that is usually with the angel community.
Thanks. Your opinion?
I would agree with that completely. I mean, that's been for me as an investor.
So disagree.
No, I'm sorry. I don't disagree. I mean, one of the things for me as an angel investor and also as an LP with Halogen Ventures, which maybe is an exception, we are very involved in helping our companies with their success. One of the things that Halogen has done is stood up an operators program. We call it HOP. And a handful of people have gotten involved with the brands that we are investing in and helping to support them. And they actually are allowed to come to us as this operator and ask us questions that we kind of don't take back to the overarching VC. It's kind of we make a little bit of a joke that like what happens in Vegas stays in Vegas. Same thing when you're talking to the HOP board. What you talk to us about stays with us and doesn't necessarily go back to the bigger investment group. But because of that, we're able to help them. I mean, it's our money. We want them to succeed. How can we take our skill set and bring that to help our founders?
Well, generally, at every panel I participate, I'm always the guy who is contrary to whatever was said. Guys, I wrote a book about 12 years ago called 100 Doors. Talks about the long way of entrepreneurship. And in this book, I hated VCs. So half of my book says VCs are fact. And then I became a VC. Yeah. The real answer, in my opinion, it depends. It depends who are the angels. It depends who are the VCs. Guys, you go to raise money, it's okay to raise from great angels. It's very good to raise money from very good VCs. Look at the guys who are putting the money into your company because they are going to be truly your partners, whether you want it later or not. They are partners. It's like marriage. You cannot marry and then say, hey, actually it's stronger than marriage because if you are unhappy in your marriage, you tell the guy, get out of here. And you can't tell it to your business partner. Let's go to AI. Okay, is that okay with you guys? AI. We'll talk about AI. I'm just testing your hearing. Do you want to hear about AI? Raise your hand if the answer is yes. Okay, let me ask the other question. Is it right that no one here wants to hear about AI? Raise your hands. Well, it's the same guy who raised his hands. So do I lack the ability, or is it my terrible accent, or we'll talk about AI, guys. Otherwise, they won't invite me next year. So we talked about how to reach to the first $1 million. How AI is going to help us or not help us doing that?
Well, I think, Barry, you said it. One of the challenges we've got with AI is it's sucking up all the money in the investment community. So I think there's many angles I could take on your question. AI has become some ubiquitous. I mean, we can use AI to help us build our businesses. We can use it to help us come up with ideas, to challenge ideas that we have on our own. Although it's not coming up with new things, it's regurgitating what's on the web. So use it to help your business. From an investing perspective, I'm troubled by how much money is going towards AI. I mean, we look at the stock market right now, it's held up by AI companies and AI investing. What's happening to everything else out there? So I'm not sure how to take your question. AI's here; it's here to stay. Like we're going to continue to invest in it. People are going to continue to use it, but I also think we need to start kind of stepping away from it as we make investments, because there are a lot of other interesting things out there, and it's not going to be the only thing in the world as we continue in our futures.
Yeah, I can add one thing. So here's the AI for most of us. If you work on a large language model, that's okay. But if you're not, AI is just a utility for you. How important it is? Just like you have water, you have electricity. Today, if you're building a house without water, without electricity, you're crazy. Today, if you are doing anything without AI, you are doomed. You have to use AI. But AI is not the mode. You can even generate a software. There's one saying before, like the software is eating the world, right? But today, if you start a so-called software company, it's worthless. Software is worthless. Intelligent worth a lot of money, but where the intelligence come from? Intelligence come from data, as Barry mentioned. Private data, customer data are the gold. As long as you have the data, then you can leverage, use AI to grow. So always use AI as a utility. Then you can grow. Don't just say AI. AI means nothing because everybody is supposed to use AI. Just like you tell me you know how to drive a car. It doesn't mean anything anymore. Where's the data?
Thank you so much. Have a great show.